Good morning, everyone. Happy Monday, and welcome to Saxo's weekly market outlook call. Today is May 8th, 2023, and I will be taking you through what's the latest in the markets and what key data and events and also earnings to watch this week, which can be critical for your portfolios. My name is Charu Chanana. I'm a market strategist with Saxo Singapore. And let me just share my slides with you so we can get started. Okay. So perhaps we'll begin the discussion with the big picture first. What's really happening in the markets? So we really have two big themes playing out right now. One, of course, the banking crisis, and the second is the Fed pause, or more broadly, let's call it the Fed policy and how the market is really interpreting it. So, starting with the banking crisis first, last week, obviously, regional bank crisis concerns were reignited because of deposit concerns, and there were massive falls in the share prices for some of the regional lenders like PacWest, like Western Alliance, up until Thursday at least. And although these stocks did see a sharp recovery on Friday, but that was again there was no particular catalyst, neither for the sharp declines that came early in the week or nor for the recovery as well on Friday. It just remains a pure sentiment play. Confidence is pretty weak, particularly in the regional banks, and data is suggesting that bank runs are accelerating. Now, whether you look at the money market data, the chart on the right hand side in the slide, money market inflows have accounted to over $100 billion in the last 2 weeks. So that means that depositors are panicking, which is not a good sign for the banking sector anyway. So they are withdrawing funds from banks, more so from smaller regional banks, and moving them either to big banks or to money markets, just some safe havens. So they are withdrawing, and that does mean that capital for regional banks is eroding. And that is a big risk for the economy, as tightening lending standards can bring in a very quick recession, even if it's not broad-based recession, but the vulnerable parts of the economy will suffer. Companies that depend heavily on fundings, small and medium enterprises, we can potentially see bankruptcies going much higher in that part of the economy. So, to keep a watch on that, today we have a senior loan officers survey due in the US. It's a quarterly survey on bank lending, and a similar survey was out from the European Central Bank as well last week, which was a big red flag as it showed a sharp weakening in credit demand, along with, of course, slowing credit supply as well. And if we do see any similar outcomes in the US survey as well today, that can potentially spark another risk off in the markets, and concerns around the banking sector, depositors fleeing away as well. So, I think that's something really critical to watch this time around. The other big story, as I mentioned at the start, is really the Fed policy now, where last week's 25 basis points rate hike is being touted to be the last in the cycle, as the policy statement kind of hinted at a pause. But in essence, I think it is really a data dependent mode from here. It could be a pause now for some months. We don't know. It could also mean that the next rate move will potentially be a cut. But again, hard to say that right now. Most importantly, it really depends on how the banking crisis evolves from here. So markets are actually pricing in a full rate cut now for September, and still about 75 to 100 basis points of rate cuts for this year. Although Chair Powell clearly said at the meeting last week that they won't be cutting rates this year. Now, the green line here in this chart, if you can see the slides, that is reflecting the current pricing by the markets for the Fed, and compare it to the yellow dotted line, which is early March, the 1st of March, before really the banking concerns started. So that's just reflecting such a steep dovish turn in expectations of the Fed that we've seen over the last a month or so. And that has come despite the fact that inflation, hasn't really come down to target. We do have the April CPI coming out in the US this week on Wednesday, and prices will likely remain sticky, at least on the services side, although, overall we could potentially see a broad cooling there. But that in itself is not enough for the Fed. It really has to be the banking crisis which brings in rate cuts. And if you look at this market pricing and what the Fed is saying, just the whole disconnect, it appears that obviously markets are expecting the banking crisis to take a turn for the worse from here, even though the Fed still thinks that it's not a huge risk at the moment. And also, of course, a lot of caution from the deadlock that we are seeing over the debt ceiling. So that can also bring some additional near-term stress on the financial markets. Now, with that backdrop in mind, let's take a look at how the markets have performed last week. So equities, as you can see here, flat to down. Mostly the gains on Friday helped to pare the losses over the earlier part of the week, which were actually the worst since the SBB collapse that we saw in March. And on Friday, we had this strong print for the US non-farm payrolls, the jobs data. And usually such a print brings, the trend that good news is bad news. But this time, the reaction function from the markets was completely the reverse of that. It was good news because it kind of helped to ease some of the fears of a recession, and it still did not bring back any rate hike expectations. So, market is still pricing in a pause from the Fed in June and rate cuts thereafter, as I said earlier. So, equity markets did get a reason to rally on the fact that the labor market is still quite strong. So the recession may not be as broad based or as steep as the market was fearing it to be. But it didn't potentially bring any change to Fed pricing. So I think that is really the key point here, and we need to monitor how that changes, the reaction function changes to the US CPI, which is due on Wednesday this week. On the FX side, US dollar was modestly weaker in the week. Gains were mostly led by commodity currencies, Aussie and Kiwi, because Aussie we got a surprise hike from the RBA, and Kiwi we got a Q1 jobs data, which was pretty upbeat again. So I think some more tightening expectations still building in there. I don't know how long that can last for the Aussie dollar. That really is something to watch. But surprisingly, Euro ended the week absolutely unchanged, despite ECB trying to be hawkish. ECB also raised rates by 25 basis points last week, and the chatter was a little bit obviously more hawkish than the Fed, but the markets still think that ECB will follow the Fed and stop hiking rates by summer. So again, that's playing into the euro outlook from here. And the other big currency which remains a focus is certainly the Japanese yen as well, because of the high amount of volatility that we're seeing in US rates and treasury yields. Turning over to commodities, oil had a pretty tough week, as short sellers were mostly in control for most part of the week, but we did see some respite on Friday. Oil was up 4%, and I think the OPEC report this week for the monthly demand and supply report that they come out with is going to be pretty interesting to watch. But of course, this is a market which remains very volatile because of demand concerns in the near term, and then the supply outlook as well remaining pretty volatile given the OPEC cuts and the underinvestment in the sector. So I think it's a very volatile space to be in right now. Whereas gold, it got really close to an all-time high last week. A lot of supporting factors there. Fed pause, obviously the big reason. It usually brings a strong rally in gold. Then banking concerns also, of course, spooking risks of a recession, and then of course that turns investors to safe haven stores of value such as gold. And central bank buying of gold also continues to pick up. You can see the headline here on the slide. Over the weekend, China reported raising its gold holdings by over 8 million tons in April, which is its sixth consecutive monthly addition to reserves, as it is obviously trying to bring down its dependence on the US dollar amid all the geopolitical tensions. So I think that story really obviously continues to support demand for gold as well. And so great. I mean, if you have exposure to gold, I think it's certainly something that you should maintain. But if you're looking to enter, perhaps wait for some consolidation. This week's CPI could be key. If we do see a very hot print, again, that could bring some reversal, some consolidation. But of course, yeah, I mean, I think it's something that you should potentially have on your radar to gain exposure. So on to what to watch this week. in terms of on the economic calendar, we have discussed most of the items. Some of the other things to keep an eye out is the China credit data. That could be key. The Golden Week travel numbers did appear to be pretty robust, but overall the rebound remains to be slow moving, and it's not what investors were expecting initially when China announced the reopening. So of course, there's a lot of potential for the push from the authorities, and that will be something that will be visible in these credit numbers, loan numbers that come out sometime this week. We also have China's CPI and trade numbers due, but that maybe is a little bit of less focus, less of a market mover there. We have the Bank of England meeting as well, expected to hike 25 basis points again, and core inflation, being still sticky while economic momentum has been better than expected. So they, again, much like the ECB, they can leave the door open for further tightening. But now the question really is whether the markets will again believe the BOE, much like the ECB. They did not kind of take the hawkish message that they tried to deliver. So cable strength, certainly a key risk going into this week, I would say. But obviously still also depends on how the US banking situation evolves and the US CPI on Wednesday. On the earnings front, the focus is shifting somewhat to consumer companies in the coming week, with tech and bank earnings mostly out of the way. So we need to watch how spending patterns have evolved amid the rise in interest rates and any fears of the banking crisis or an economic slowdown as well. So there's something to watch from PayPal today, Tyson Foods also. Airbnb, we are getting on Tuesday, will be another test of the global travel recovery, and also I think the big focus in that travel recovery now is the Chinese travel, Chinese outbound travel, how quickly that is recovering. So I think those are some of the comments that would potentially make a big difference this week. Disney on Wednesday, key to monitor again for any further cost-cutting measures that may be announced, and if they could provide any further boost to Walt Disney. Then I think the focus also turning a lot more to Japanese companies this week. A lot of clients have been obviously asking us about some interesting names in the Japanese equity markets, given the recent surge that we've seen in interest, after Warren Buffett's nod to Japan. So Nintendo, Toyota, SoftBank, I think some of these will be interesting names reporting in Japan this week. And I think I just also wanted to kind of put this up here once before we close, because there are rising concerns among investors about an impending credit crunch or potentially a recession as well. We still think the US economy can skirt a recession, but weaker parts of the economy obviously look vulnerable, and they might be impacted by the ongoing banking crisis. I think it's obviously important to keep that in your mind when you're looking at your portfolio. Over the weekend, we also had Warren Buffett, at his annual shareholder conference. He sounded some alarms on the US economic momentum and said that they're reducing their exposure there. So if you are looking to protect your portfolio, it would probably be a good idea to add some safe havens, some dividend exposure, and diversify outside of the US. This chart in black on the right hand side, you can see that it shows specifically the chart on the right there. It shows that the sectors like healthcare and consumer staples, they usually outperform in the 3 months after the last Fed rate hike. So, and remember, if at all we get a recession, of course, keep also some cash ready to jump into stocks that you want in your portfolios for the long term, as they will be obviously potentially, be available on a discount. So I think just extremely important to stay active, stay nimble with your portfolios. And that's it from me today. I hope you enjoyed the discussion. Thank you for attending today. And you can always check back on the Saxo platform or the website to get access to any of our SaxoStrat research as well. Have a good day.